Okay, imagine a lot full of shiny cars, a counter with a smiling agent, and a business model so simple a child could explain it. Buy cars, rent them out, collect the daily rate, repeat. You own a piece of that. Easy money on wheels. Your fortune in car rental? It lives in what the car is worth the day you sell it. Honestly, the daily rate you charge while you're renting it out barely factors into that math. The rental income is just the interest payment while you wait. Every car on your lot is a short-term stock position wearing a rental company's paint job, and the daily rate you charge, that's just the dividend while you wait to sell the position. You're in the buy low, sell later business first. The driving is just how you keep the asset from sitting idle while you wait for the right moment to unload it. Here's what getting into that position has cost people. Across a century of trying. Back in September of 1918, a 22-year-old car salesman named Walter Jacobs started a rental business in Chicago, with a dozen Ford Model Ts, repairing every car himself, in a small garage. By 1923, that dozen-car operation was generating somewhere around $1 million a year. Enough that Jacobs sold the whole thing to John Hertz, head of the yellow cab and yellow truck companies. The entry cost of the modern car rental industry wasn't a factory, wasn't a patent. It was a young man with wrenches, 12 borrowed-looking cars, and the willingness to fix every one of them himself. By 1954, the scale had changed completely. The newly public Hertz Corporation bought a truck leasing pioneer called Metropolitan Distributors for $6,750,000 in cash, absorbing a fleet of 4,000 trucks in a single deal. Fast forward to today, and Hertz alone operates somewhere around 490,000 vehicles worldwide, financed through asset-backed securitization programs carrying somewhere around $12 billion in outstanding debt against the fleet. You don't buy your way into this industry at scale with cash on hand. You buy your way in by borrowing against cars that are already losing value the moment you drive them off the lot. Some entries look nothing like Hertz's, though. Enterprise Holdings, the largest rental company in the world by fleet size, revenue, and employee count, has stayed privately owned by the Taylor family of St. Louis for its entire existence, and recently posted a record year with revenue somewhere around $38 billion, a figure that's grown roughly threefold over the past decade and a half. No public shareholders, no quarterly earnings calls, no stock price to defend. Just one family, compounding a car rental business quietly for decades, while its publicly traded rivals rode very different roller coasters through the same stretch of history. Ownership structure alone, before a single car gets purchased, already sorts this industry into two very different risk profiles. There's a fifth entry cost, and it's one you pay every single day you operate at an airport, rather than a strip mall down the road. Airports typically charge on-site rental companies somewhere around 10 to 12% of gross airport-related revenue, just for the right to keep a counter and a shuttle bus on airport property. That fee exists because airport curb space is some of the most valuable, most captive real estate on Earth, and the airport authority knows it. A traveler stepping off a flight rarely bothers researching a cheaper option 5 miles away when a counter is standing right there in the terminal. Set up shop off airport instead, and you dodge that toll, but you also lose most of the walk-up customers who rarely bother looking anywhere else. Now, here's the cost driver that catches almost every new owner off guard. Ready? A rental car's biggest expense isn't fuel, isn't a flat tire, isn't even a fender bender. It's depreciation, the gap between what you paid for the car and what it's worth by the time you sell it. In a normal stretch, that cost runs somewhere around $200 per vehicle per month. During a stretch when used vehicle values are falling hard, that same number can climb past $600 per vehicle per month, 3 times higher, on the exact same car, with nothing about the vehicle itself having changed. The car didn't get worse, the market underneath it moved. And every rental company on Earth is exposed to that market, regardless of whether it welcomes the exposure. Multiply a few $100s of extra monthly depreciation across a fleet of hundreds of thousands of vehicles, and a shift that sounds small at the level of one car becomes a swing of hundreds of millions of dollars at the level of the whole company. Acquiring the fleet is only your entry fee. Owning a piece of this industry means paying, every single month, for the debt used to buy that fleet in the first place. And that bill moves with forces you have zero control over. One major rental company's fleet financing interest expense ran somewhere around $55 per vehicle per month at one point, then climbed to somewhere around $90 per vehicle per month roughly a year later, an increase the company attributed directly to the broader rising interest rate environment. Nothing to do with how well the company was run, everything to do with a central bank decision made in a building the company doesn't control. Layer on top of that the recurring wear and tear costs, collision repair, cleaning and turnaround labor between renters, insurance, and a maintenance schedule that runs continuously, because a car sitting idle in your lot is a car earning you nothing, while the depreciation clock keeps running regardless. Every one of those turnaround roles, the person who inspects the car, refuels it, gets it back on the lot within the hour, has to be staffed around the clock at a major airport location. A rental counter with an empty lot and a line of waiting customers is losing money in real time. Some of your spending buys you nothing you can point to on an invoice, and you fund it anyway, because the alternative is losing customers to a competitor's counter. Loyalty programs, the kind that let a frequent renter skip the line and walk straight to a car, cost real money to run and rarely pay for themselves on any single transaction. They exist purely to keep a business traveler from comparison shopping every single trip. Fleet telematics and GPS tracking systems cost money with no line item return of their own, existing only to recover a stolen car or settle a damage dispute before it becomes a lawsuit. And when an entire industry decides to chase a new technology, electric vehicles, say, the charging infrastructure, technician retraining, and specialized parts inventory all have to get funded up front, years before anyone knows whether the bet pays off. None of that spending shows up as a benefit on this quarter's balance sheet. All of it shows up as a liability the moment the bet stops looking clever. Your business sits exposed to shocks that arrive with zero warning and can erase years of profit in a single season. A pandemic that grounds air travel overnight. An interest rate spike that doubles your fleet financing bill. Or a sudden collapse in the resale value of an entire category of vehicle you happen to be holding in bulk. None of these risks originate inside your own operation, and none of them respond to how well you run your counters or how clean you keep your cars. So, where does the money you make go once you clear all of that? The daily rental rate is only the headline number. Airport surcharges, insurance upsells, fuel service charges, and add-on protection plans routinely add a meaningful share on top of the quoted price. A growing slice of demand now comes from rideshare and delivery drivers renting a vehicle by the week rather than owning one outright, a customer segment that barely existed 2 decades ago and now shows up explicitly in major rental companies' own reporting as a named growth channel. And here's a number worth flagging honestly. Nobody agrees on how big this global industry even is. Depending on which research firm you ask, the global car rental market is worth somewhere around $86 billion, or somewhere around $150 billion, or somewhere north of $200 billion. A gap of well over $100 billion between estimates for the exact same industry in the exact same year. What almost every one of those conflicting estimates agrees on, though, is the direction. The industry cratered during the pandemic travel collapse and has been climbing back since, pushed by a recovery in global tourism, business travel, and rideshare-driven demand. This is what a debt-financed fleet business can do to you when the demand underneath it disappears overnight. In May of 2020, Hertz filed for Chapter 11 bankruptcy protection, carrying somewhere around $19 billion in debt, roughly double its prior year's revenue, against under $1 billion of cash on hand. The trigger was blunt. The COVID-19 pandemic grounded global air travel almost instantly, and Hertz's revenue fell by around 90% year over year in the weeks before the filing. A rental company can survive a slow quarter. It cannot survive a quarter with almost no rental income at all, while still owing regular payments on somewhere around $10 billion of debt secured directly against its own fleet. Under the terms of its bankruptcy proceedings, Hertz was required to dispose of more than 180,000 leased vehicles in a matter of months, just to keep its lenders whole. The company emerged from Chapter 11 about 13 months later, in June of 2021, in an outcome unusual enough that lawyers still cite it as a case study. Creditors were paid back in full, and equity holders, the shareholders who are normally wiped out completely in a bankruptcy like this, still received more than $1 billion in value on the way out. The mechanism that broke Hertz wasn't bad management. It was a debt structure built for steady, predictable demand, colliding with a shock that made demand disappear for months at a time. The very same fleet liquidation that helped Hertz survive 2020 set up a strange twist the following year. Every rental company had sold off a chunk of its fleet during the pandemic to raise cash, and by 2021, a global semiconductor shortage was choking new car production worldwide, leaving automakers unable to rebuild those depleted fleets fast enough. Rental companies were forced into used car auctions to restock, competing directly with ordinary consumers for the same shrinking pool of cars. And the average price of a used vehicle jumped by somewhere around 30% within a single year. For a company holding on to any of its own older fleet at that moment, that spike briefly turned depreciation into appreciation. The exact opposite of the mechanism that had just forced Hertz into bankruptcy months earlier. A newly solvent Hertz, riding that unexpected tailwind, and a wave of investor enthusiasm for electric vehicles, made its next move from a position of confidence rather than desperation. That same structural weakness didn't stay in the past for long. Barely 5 months after emerging from bankruptcy, Hertz announced, in October of 2021, that it would purchase somewhere around 100,000 vehicles from Tesla, a deal worth somewhere around $4,200,000,000 at the time. The bet looked smart initially, arriving right as electric vehicle stocks were commanding sky-high valuations across the market. It fell apart for the same underlying reason the 2020 bankruptcy did. The value of the fleet underneath the company moved sharply, and Hertz was holding a large concentrated position when it happened. Tesla cut prices repeatedly on its own new vehicles, which dragged down the resale value of every used Tesla on the market, including the tens of thousands sitting in Hertz's fleet. By 2024, Hertz was reporting a loss of somewhere around $2,900,000,000 for the year, tied directly to its EV strategy, with per-vehicle depreciation at one point tripling versus the prior year. The company's chief executive resigned that same year. 2 different decades, 2 completely different triggers, a global pandemic in one case, an electric vehicle price war in the other, and the identical underlying mechanism. A fleet-heavy rental business is a leveraged bet on the resale value of its own inventory. And when that resale value moves against you fast enough, no amount of operational excellence at the rental counter saves you. Some players in this space carry a completely different exposure, and the difference comes down to what each business model owns, structurally, before a single rental transaction ever happens. A peer-to-peer platform like Turo buys 0 cars of its own. It takes a commission on rentals between private car owners and renters, which means Turo's own balance sheet carries none of the depreciation risk that broke Hertz twice. That lighter structure comes with its own weakness, though. Turo's net income fell from somewhere around $155 million in one recent year to somewhere around $15 million in the very next year, even as revenue kept growing. And the company shelved its own planned public stock offering and cut roughly 15% of its staff. Its closest peer-to-peer competitor, Getaround, fared worse. After raising somewhere around $750 million in funding over its lifetime, and going public through a shell company merger, Getaround shut down its entire United States operating business in February of 2025, citing an ongoing lack of liquidity, with its stock having lost more than 99% of its value. Owning no cars protects you from depreciation risk. It leaves you exposed instead to running out of cash, in a crowded market with thin commissions, its own version of the exact same problem, wearing a different outfit. Some exits from this industry look almost graceful by comparison. Zipcar, an early car-sharing pioneer, got acquired by Avis Budget Group for somewhere around $500 million back in 2013, giving its investors a clean payday. Most exits look far less graceful: a shut-down platform, a stranded customer mid-rental, laid-off staff, and a wind-down filing working through who gets paid first out of what's left. At the level of a single car, rather than a whole company, the exit is more mundane. After roughly 6 to 18 months of rental use, most vehicles get sold off through dedicated used car channels or dealer auctions, which is precisely where that depreciation number you heard about earlier gets converted from an accounting estimate into an actual, realized cash loss or gain. On a pure input versus output basis, this industry rewards patience with debt and punishes concentration risk, and it rewards those two things very differently depending on which corner of it you're standing in. The airport-based, fleet-owning giants carry the heaviest exposure. Hertz has now been brought to its knees twice in 5 years, by 2 unrelated shocks to the value of the exact same asset class it depends on. One triggered by a virus, one triggered by a rival automaker's pricing strategy. The privately held, family-run model that Enterprise represents has weathered the same 20-year stretch without a comparable public collapse, insulated in part by an ownership structure that answers to no public shareholders or bondholders demanding a fixed payment on a fixed date. The asset-light, peer-to-peer model trades fleet depreciation risk for cash burn risk, and the evidence from Turo and Getaround shows that trade is far from automatically safer, just differently risky. Here's what a spreadsheet leaves out, though. Your business sits directly downstream of decisions nobody in it lets you control. A central bank setting interest rates, an automaker setting new vehicle prices that ripple straight through to used vehicle values, a virus altering how many people fly, a computer chip factory on the other side of the world running short on capacity for reasons that have nothing to do with cars at all. And your business sits directly upstream of things that ripple out from it in turn: rideshare and delivery economies that depend on short-term vehicle access, used car markets that absorb hundreds of thousands of ex-rental vehicles a year, and tourism economies in destinations that rely on visitors being able to rent a car the moment they land. Pull on any single thread in this industry, an interest rate, a chip factory, a pandemic, a price cut on a competing product, and something a chain of steps away moves in response, usually before you notice why your own numbers just shifted. You're holding a stock position on wheels either way, whether you own 500,000 of them or 5. Dun du napos a dam thumb, usually every dolls, and idiapol canive. And somewhere on a balance sheet, that bet keeps running, whether anyone at the counter ever mentions it.